In this lecture, we're going to continue our discussion related to the audit process and talk about very specific activities and phases that take place in the course of the audit where we are attempting to express an opinion of the financial statements, and if we're doing the opinion also of the integrated audit of internal controls over financial reporting, the audit of internal controls. Exhibit 5.3 from our book identifies some very specific phases. Now we're going to get into a little bit more detail related to these as time goes on, but let's just kind of look through what it is that we are attempting to do. You notice that the first phase, making client acceptance and continuation decisions. So the question that we have is, should we accept the client and should we continue with the client? Now there's specific issues that we need to contend with as we are working through this process, and these are some things that we're going to be talking about in our next lecture. The next piece is to perform the risk assessment. Now I want to focus on the next three phases and talk about how these are integrated in relationship to the audit. So we perform a risk assessment. We obtain evidence about internal controls relating to the operating effectiveness, if applicable. And then finally, we obtain substantive evidence about controls and disclosures and assertions. So there's a three-step process, and we need to understand the specific elements related to these phases. And in fact, as you're working through the CPA exam, it's very important for you to understand what phase you're in as you're asking the question. For example, if the question is during the risk assessment phase or during the beginning steps of the audit, well, the beginning step of the audit is the risk assessment. So in the risk assessment process, we are identifying and assessing the risk of material misstatement. So you notice that we are looking and focusing on the risk of material misstatement. We respond to identified risks of material misstatement. We respond to these in terms of developing a higher risk of material misstatement as we are developing our further test. This coincides with the evidence related to internal controls. So we select controls, we perform the test of controls, and we consider the results of these controls as it relates to the risk assessment. So keep in mind that the risk is what could go wrong. The internal controls are the controls that management has implemented in regards to mitigating this risk. Together, these two elements of internal control testing and our risk assessment helps us understand the risk of material misstatement. But keep in mind, the audit is not identifying the risk of material misstatement, but to identify material errors. And this is where we get to phase 4. Phase 4 is where we are obtaining substantive evidence about accounts, disclosures, and assertions. Now, I believe this is the first time we've included the word assertions related to this. We'll actually introduce this concept today in our discussion. So what we're going to do in this phase is to perform appropriate substantive procedures. Now, keep in mind, and this is very important to understand, is that when we do our test of controls, we are essentially in this phase where we are assessing the risk of material misstatement. When we move to substantive testing, this is where we are measuring monetary misstatement. Our opinion is based upon the measurement of monetary misstatements. Once we have completed this measurement, we then complete the audit and make our reporting decision. So we complete the review, we complete our communication activities, we determine the type or types of opinions that we're going to issue. In the next couple of slides, we're going to talk about how we actually break down the audit. So you notice that the two key elements relate to the accounting cycles and management assertions. We'll talk also about evidence and procedures as well as documentation, but let's focus on these first two items of cycles and management assertions. So when we talk about accounting cycles, what we're talking about is we're talking about a process. So as an example, the revenue process is an accounting cycle. where we have similar transactions that are linked by procedures and controls that affect related accounts. So let's consider the revenue cycle. So the revenue cycle starts at the point of sale and ends with the collection of cash. So it ends with cash collection. So in the process, we have transactions. Transactions are the sales transaction, the transaction related to posting cash, but we also have specific accounts. We have accounts receivable, we have sales returns, we have sales allowances. These types of accounts are related accounts that affect the primary cycle, and as we're looking through the cycle, we're able to look at this from a very comprehensive perspective. Another example is a purchasing cycle. Purchasing cycle starts with the purchase requisition, moves to the purchase order, the items are received, the items, then the accounts payable receives the invoice from the vendor, the accounts payable matches this invoice to what was received and what was ordered, and then it goes to the cash disbursement where the item is actually paid. So you notice that in the purchasing cycle, we have purchase transactions, we have the accounts payable, we have various accounts and various transactions that are appropriate to this cycle. Individual auditors or teams are typically assigned to an audit of a particular accounting cycle. And as you work through these accounting cycles, chances are you're going to gain a skill set in terms of what you're actually looking for. So the auditor is looking for the flow of transactions within a particular cycle. So when we think about transactions, we're thinking about this from the process of internal controls. So transactions require internal controls. What we're attempting to do is we're attempting to identify points where material misstatements can occur, and we are looking for controls that have been designed and implemented to mitigate those controls. So it's very important that we understand both the risks and controls with each cycle. So again, as we're looking at the control process within the cycles, what we're focusing on is the transactions. Now, when we are measuring monetary misstatement, we are looking for monetary misstatement within these account balances. But again, from an internal control perspective, we are looking at this from a transactional perspective. Okay, so as we talked earlier in a couple of slides, that there's two key elements. The first key element is where we're looking at the accounting cycles, a revenue cycle, a purchasing cycle, the payroll cycle. Each of these cycles means something in terms of transactions and account balances. But the other piece associated with this is management assertions. So the question becomes is within these cycles, what are we actually testing? Well, the answer is we are testing management assertions. Well, what is a management assertion? Keep in mind that the financial statements are the responsibility of management. Embedded within these financial statements and these account balances are assertions. These are assertions that are implied or explicit, but these assertions mean something in terms of what management is saying in regards to the account or the transaction. So as an example, you notice the first item is existence or occurrence. Now just keep in mind that when we talk about existence, we're talking about account balances. When we're talking about occurrences, we're talking about transactions. So from an occurrence perspective, if management is saying that sales is $1 million, what management is asserting is that these sales actually occurred. Okay? So existence and occurrence relate to assets and liabilities. They also refer to the occurrence of recorded transactions. Now, the opposite of existence and occurrence is completeness. Completeness refers to the inclusion that all transactions and accounts are complete within the financial statement. So you notice that we're talking about completeness and we're talking about, we'll use the word existence. So if we're looking at fixed assets and management is asserting that they have 1,000 fixed assets valued at $1 million. What management is saying is that every asset identified in the financial statement actually exists. And it's also saying that that list of assets that's on the financial statement is complete. So as part of our audit is we would take the financial statements, identify assets, and go out and find them in terms of the existence. We would also randomly look for assets and determine whether or not these assets are actually included in the financial statements. So again, existence, completeness are the opposites in terms of what we're testing related to account balances. When we look at occurrence and completeness, we're looking at transactions. So on a sales transaction, has the transaction occurred? And the listing of sales transactions that are there, is it actually complete? You notice the next item is valuation or allocation. The next question relates to the valuation of the assets as well as the sales. So the question, sales or transactions. So the question becomes is, are these valued appropriately? As an example, if we're looking at accounts receivable, what's is part of the financial statements relates to the net accounts receivable. In other words, the accounts receivable less the allowance for doubtful account. This is a valuation decision that management has made. So what we're doing in regards to the audit process is determining if the valuation of accounts receivable is appropriate. And this is just one example. Rights and obligations. Well, the question becomes is, the asset may be there, but in fact, we may not have rights to it. As an example, it's perhaps the accounts receivable are valid, they exist, and they're complete. But the question becomes is, do we have rights to these? It's possible that management has factored or sold these accounts receivables to a third party, a legitimate transaction, but we want to make sure that we actually are accounting for these on the financial statements appropriately. When we look at presentation and disclosures, this clearly refers to the notes within the financial statements, and this refers to these items being properly classified, described, and disclosed. A couple of definitions that we need to focus in on. And if you remember in our last discussion, we actually showed the PCAOB website where there's actually elements related to each of these within the discussion of the PCAOB website. But again, what are we talking about? Well, when we are completing an audit, we are making our decision in regards to the fair presentation of the financial statements based upon audit evidence. Audit evidence is information, and in fact, all information used by the auditor in arriving at conclusions on which the opinion is based. So everything that we observe becomes a part of everything that we observe and everything that we test becomes a part of our understanding of the organization and is part of what we use, which is the basis of our opinion. In fact, audit evidence includes observation and inquiry. So part of the internal control process is we're asking questions and we are observing. We're actually determining what the internal controls are based upon asking these questions and then observing these controls in process. Audit procedures are procedures designed to obtain audit evidence to support our opinions. Now you notice the next two words is sufficiency and appropriateness of audit evidence. Sufficiency and appropriateness measures the quantity. So sufficiency is quantity and appropriateness is quality. When you think about appropriateness, we're thinking about, is the evidence actually supporting the management assertion that we're testing? The audit program is simply the list of procedures to be followed in gathering the evidence. This helps monitor the process and helps supervisors supervise the activities. The risk assessment procedures provide information regarding assessing the risk of material misstatements in the financial statements. It's used for the purpose of planning the audit. So again, what we've talked about in an earlier slide was that the risk assessment procedures is we're basically gaining an understanding of the entity and its environment. We're identifying, we'll talk about this in the next presentation, the inherent risk related to classes of transactions and account balances. But we're using this in conjunction with our test of controls. And the test of controls essentially is management's approach to addressing these risks. Based upon the risk assessment and the test of controls, we determine the risk of material misstatement. Based upon the risk of material misstatement, and if you remember one of the general standards that we talked about in our last presentation, we determine the nature, timing, and extent of further procedures. Now, depending upon whether we're just doing testing for the financial statements or we're doing the integrated audit, is these further audit procedures would be substantive procedures or additional test of controls. But in the substantive procedures, this is part of the financial statement audit, and what we are doing is we are detecting or measuring monetary misstatement at an assertion level. So again, we're going through the accounting cycles, but based upon what our testing is, we are looking at this based upon the assertion. Again, assertions, completeness, existence, these items then become part of our testing. Based upon the test of details and substantive procedures, we're able to determine if the financial statements are free of material misstatement. So you notice the substantive procedures comprise test of details and substantive analytical procedures. So we're going to be talking about those in the next presentation, but what we want to focus on is the fact that we are using, in some cases, analytical procedures, which are essentially mathematical models. In our test of details is we're actually completing specific tests to identify whether or not the financial statements are materially misstated. But again, back to the point, is substantive procedures is where we are measuring monetary misstatement. So I hope that this short presentation provides an introduction to the audit process. We're going to have a couple of other presentations related to this, but it's very important at this phase in regards to the class that we begin to understand how we actually conduct the audit and what are the specific steps. This slide that we see right here is very important in terms of understanding where we are in the audit process. Okay, so I thank you very much. Everyone have a great day, and we will continue this in our next discussion.